start with one detractor this quarter was Axon Enterprise, the ticker AXON. They are a maker of public safety technology. Shares of Axon have been under pressure for the better part of a year as investors have rotated away from software-oriented business models and companies that are investing aggressively in product development and sales and marketing. I had the opportunity to get on the road and attend the company's customer event in Nashville, Tennessee, in April, and was struck by how motivated management is in getting our law enforcement officers AI and the best and latest technology, and two, the customer response to Axon's mission to equip our law enforcement officers with the latest and greatest technology. If anything, I came away feeling more confident in the company's ability to provide best-in-class technology to law enforcement agencies, as well as enterprise, which is an emerging category of theirs. In May, the company reported very strong earnings results and cited momentum across core product categories, as well as emerging categories such as drone defense. And so we continue to like Axon's positioning in the public safety market, and we believe when investors do want to revisit software-oriented business models, that Axon will regain favor. The second detractor that I'll talk about today is Karman Holdings, the ticker KRMN. They are a producer of highly engineered technology used in missile and rocket launch applications. This was a contributor last quarter that turned into a detractor. So what happened? I think there were industry and company-specific events that pressured shares. Starting on the industry, investors have increased their debates and discussions about the future direction and size of the U.S. defense budget, especially as we enter a midterm election cycle. And then on the company-specific side, there was a CEO transition. The company transitioned their auditor. The company reported strong, but less than expected organic revenue growth. And then there were questions about margin execution. And how we interpret the industry and as well as the company-specific events is this is a company that is maturing as a public company, and these temporary growing pains will eventually resolve. And what would be left is a company that is executing across highly prioritized defense programs, and they are a critical supplier into these markets.
Yeah, thanks, Anthony. And just to add on a little bit more broadly, I think there's still a lot of basket trading elements to the environment today. So three of our largest detractors came from long-term core holdings for us in the internet and consumer space. So Shopify, Netflix, and Mercado Libre being the three. From a fundamental level, all three of those companies beat expectations on the top line, and really highlighted by Shopify growing its revenue at the fastest rate since 2021. I just think in a volatile environment, uncertainty and the increased investment plans that all three of them cited were not looked upon favorably. And the broader internet consumer space was used as a funding source for the markets as they continue rotating into semiconductors and the AI infrastructure companies where near-term catalysts and results are a little bit more visible. Long-term, those three companies I cited are still incredible businesses who are solving problems for loyal customers around the world, and we're excited to continue investing alongside them for the future.
Two of the contributors in second quarter reflect the ongoing investor enthusiasm for artificial intelligence building blocks. And as we shared on our first quarter webinar, companies will either use AI, build AI, or be displaced by AI. And what has become evident to us is that we are still in the building block phase of artificial intelligence. Companies and governments are spending hundreds of billions of dollars a year to make AI software come to life. And we believe that spending will continue to march upward over the next 2 to 3 years. So all of this capital expenditure is a boon to processing chip companies like Advanced Micro Devices, the ticker AMD, as well as networking technology companies such as Credo, ticker CRDO, two of the contributors to results in the quarter. And this has not been a revelation. Building block providers, including NVIDIA, have been investor favor for the past 4 years now. But what has changed is the level of intensity of capital expenditure and the awareness of bottlenecks in the AI ecosystem. At least for AMD, we have heard that the big CapEx spenders want supplier diversity. And two, they are wanting to to furnish and provide foundation for agentic AI systems to purchase central processing chips, which are AMD's main product. And then as for Credo, we have learned that the number of components and devices and data centers that need connecting, that's not increasing on a linear basis, but on an exponential basis, which we believe networking as a share of total AI CapEx will increase from here. And so these are two companies in the AI ecosystem that we believe should benefit disproportionately from AI CapEx over the near future.
Yeah, I think rightly so. The semis and infrastructure trade continues to dominate the conversation. But from my side, it was nice to see the market get a little bit more discerning in the software space. So Snowflake and CrowdStrike were both standouts for us during the quarter and really push back on some of the narrative that AI is just going to destroy all software. Both companies, Snowflake and CrowdStrike, posted very strong beat and raise quarters and spoke to how tightly they're working with their customers to help accelerate AI adoption rather than be displaced by it. These companies are becoming the data control and security layers that AI adoption cannot happen without. And by selling solutions instead of seats, they continue to set themselves up to grow alongside their customers.
One surprise this quarter for me, at least, has been the near vertical rally in semiconductor stocks. For reference, the Philadelphia Stock Exchange Semiconductor Index, which is a popular gauge of these companies, is up nearly 80% in this quarter alone. And while the stock charts have been eye-popping, we keep hearing about shortages of these components and these chips and technology that are used in AI data centers. Memory chips, as an example, leading domestic supplier Micron, the ticker MU, forecasts tight supply conditions through the year, if not longer, which supports pricing and margin expansion for the company. And they have talked about entering long-term supply agreements with their customers, which could mitigate some of the boom-bust aspects that semiconductors have historically been known for. And analysts and strategists have referred to this semiconductor demand as a super cycle. And we would agree with that characterization. And our research suggests that tight supply demand dynamics could persist over the next 12, 18, even 24 months before additional production capacity comes online.
For me, the biggest surprise was consumer resilience. Like with all the macro noise, oil prices, what's happening in the Middle East, and a new Fed coming in, the headlines are really telling consumers to be worried. But management teams kept calling out a very healthy backdrop in the economy. Labor markets still very strong. Banks and card issuers pretty uniformly cited consistent spending patterns, and in some cases running even seasonally higher than they expected. And we're also starting to see some real optimism that these AI-driven productivity gains will start flowing through to the rest of the economy, which is really encouraging as we move through the rest of the year and any potential supply chain disruptions that might continue to pop up.
With the recent record listing of SpaceX and the confidential filings by AI model companies OpenAI and Anthropic, we could see 3 of the largest ever IPOs in the US this year. And after what seemed like a drought of IPO or new issuance over the past 5 years, it's been a relief, and it makes sense that there's a lot of buzz, for these IPOs. And we treat IPOs just like any other investment. Whether it's already listed or soon to be listed, we run our research process, to identify great growth and technology companies that are misunderstood or underappreciated. And we will, or we have participated in IPOs. Our goal is not to play a short-term pop or sentiment swing. our goal is to build a stake in a business that we want to own for the long term.
Yeah, and as it relates to SpaceX specifically, I know it's a popular question for the market and for our clients. So just want to give a quick rundown. There's no doubt in anybody's mind that this is an exciting business, but for us, it really all starts with the launch. The advantage of being able to put mass into orbit at a dramatically lower cost than anybody else is hard to overstate. There's a lot of people now I see making the railroad analogy, but it really is the right framework to think about. If you build, own, and operate the lowest cost way to move things around, then you can control all of the economics that are built on top of that. But what that has unlocked first for the company is connectivity through Starlink, and then AI sits on top of that as upside optionality, in our opinion. That's where, honestly, the model has the most variability as we start talking about data centers in space and Grok expansion. But it is exciting to see the company already monetizing its capacity through the partnerships they've announced with Anthropic and Alphabet. It wouldn't be a webinar without talking about Tesla in some capacity. So we keep coming back to the fact that despite all the headlines over our history of investing in Tesla, Elon has proven himself to be a once in a generation builder, which we believe aligns perfectly well with SpaceX and their business, which has driven so much of its value from the physical launch and infrastructure sides. So a fun one to watch and an interesting time in the markets, as Anthony called out, and one I'm sure we will continue to discuss more in the quarters to come.
As fundamental growth investors, we work hard to identify misunderstood and underappreciated opportunities. And underappreciated opportunities, they regularly present themselves based on what's captured in the following quote, that human beings are linear thinkers navigating an exponential world. Really, what that means is, and something that we see time and time again, that thinking in simple addition or subtraction terms often proves too conservative when trying to analyze fast growth markets or technological progress. And so it's odd to say, given the enterprise values and the media attention on the AI ecosystem, but it's possible, that we are still underestimating the economic value that AI will create as the world's intelligence is digitized and accessible by simply an internet connection. It's on the other side, it's worth discussing risks too. That risk is the other side of the coin of opportunity. And growth in technology investing, it's an optimist's game. Those who think about what can go right have demonstrated success in this style, in this pocket of the market. But we are also fiduciaries and we think about risk management as well. And so, what are top of mind risks that could be underappreciated? I think anything that could shake the risk appetite of investors and long-term savers is something that we think about constantly. Currently, it's inflation, that has run rampant and continues to remain higher, than many have desired. And then what happens to rates? And rates, as a reflection of inflation, and those both can reflect a pandemic, another geopolitical shock, or anything else. So we are trying to think through, what could, and at least in the short term, what could affect or shake risk appetite and lead to a temporary period of growth equity underperformance.
Yeah, I think to add on to Anthony's first point, to me, it's not just the durability of the CapEx cycle, but also the concentration that's happening underneath it. There's really a small handful of companies, say only 5 or 6, that are driving the majority of spending and also sentiment for the entire space. There's an interesting game theory at work where nobody wants to blink first because everybody understands the shift to AI only comes around every few decades. And the biggest risk that they see is in falling behind. These are also among the most profitable business models of all time. So that combination makes the spending stickier and potentially more durable than any skeptics are assuming. So we could still see some underappreciation in that side of the business. But it also cuts both ways. When a few players are driving everything, correlations are higher. And if even one of them starts to pull back in any capacity, it will certainly ripple through the whole complex. And that's something that we are monitoring very closely. Yeah, I'll reframe it in terms of the desert island framework that we discuss internally sometimes. So imagine you buy a stock and then you're stranded on a desert island for 5 years. What has to be true for you to be able to sleep at night and be comfortable that when you come back 5 years later, the company's still in a good position? And so for us, it comes down to three things. One, it solves a real problem in a large and growing market. So the simplest framework being, if this company disappeared tomorrow, would its customers feel pain? The answer to that is yes, and the market it serves is large and expanding as evidenced by revenue growth, then we're in the right place. Secondly, we look for companies that are founder-led or run by an owner-operator that we can trust. We like to say that we have a sometimes novel opinion that people still matter, and by partnering and investing alongside these exceptional leaders, we have the ability to participate in value creation that doesn't fit neatly into a spreadsheet. And then third, the company has to have the ability to invest in itself. A strong balance sheet and improving unit economics are key traits that help turn great ideas into multi-year compounders, and they allow a company to navigate any short-term disruptions along the way. So one solves a real problem, has exceptional people you trust, and then the financial strength to compound. If those three characteristics are all in place, then we feel pretty good about where we're at from a starting point.
As I think about our strategies and the opportunity that lies ahead, I come back to this. We're living in a period of significant technological change. Change creates opportunity, and change can create risk. And so, by nature, passive indices reflect historical information, and they're not designed to anticipate positive inflections of growth or success or negative inflections of risk. But we know that where we've been, that historical information isn't necessarily where we're going. And so we continue to believe in the merits of forward thinking, of flexible, active, management in these pockets of the market that are highly dynamic. And in the age of AI, where we increasingly believe that access to information or even analysis of that information is becoming commoditized, that the value that we provide and the value that market participants can offer in terms of edge is through discipline, through temperament and behavior. And we have 40 years of pattern recognition and execution and displaying judgment in these pockets of the market for the ultimate success of our clients. So we're very excited about what lies ahead, and we continue to maintain our strict discipline on what we do best.